The Wyckoff method is a trading approach developed by Richard D. Wyckoff. It suggests that prices are driven by the intentions of large market movers or institutional traders. It follows a series of steps to recognize where these players are likely to drive the market. This method involves identifying distinct phases in price cycles: accumulation, markup, distribution, and markdown, to inform buying and selling decisions. In this video, we won't delve into the Wyckoff methodology due to its complexity, which isn't ideal for a brief YouTube video. Instead, we'll look at simple, clear strategies using candlestick patterns inspired by the methodology. This way, you can leverage the strengths of this excellent trading approach without dealing with all the complexity. In the first scenario, the market takes a breather following a significant move, entering a phase of consolidation. It's characterized by a series of overlapping candles reflecting a period where prices stabilize. The price then breaks through the support or resistance zone, but suddenly rejects it by forming an engulfing candle. This candle stands out as it covers a broader price range than the candles preceding it. On occasion, this candle may retrace the entire price movement before it. It might even close at a record low beyond the range of the previous candles. When trading with this strategy, it's beneficial to zoom in on a lower time frame to spot any possible divergence between the price and the indicator. Additionally, these smaller time frames are like getting a closer look under a microscope. This allows you to observe the intricate details of Wyckoff patterns, which are the backbone of this strategy. Drawing from this methodology, we're identifying a distribution pattern where smart money actively maneuvers to influence other traders. Here you get a clearer view of a crucial element in distribution patterns, the move that breaks through the resistance level but fails to sustain itself above it. This specific move is commonly known as an upthrust, or UT. Moreover, keeping a keen eye on the trading volume in that vicinity can offer crucial clues about the pattern's potential success. Typically, you'd expect to see a spike in volume near the fake-out area. That kind of above-average activity can be quite telling. This pattern often indicates a strong reversal. Typically, the exit from this pattern happens with high momentum. However, the market sometimes offers a second shot for those who missed the initial move, especially when it dips back into the previously broken range. As for take profits, we can use different approaches according to our strategies and trading styles. Personally, I find placing the take profit at the start of the impulsive move that triggered the price jump to be quite effective. Sometimes the smart money keeps pushing the highs until they gather enough liquidity to steer the market towards their desired direction. Take a look at this. We've seen this maneuvering occur twice now, and after the second long bearish engulfing candle, which nearly overshadowed all of its predecessors, we can conclude that the distribution phase has wrapped up, and we're now on our way to lower levels. Here, if we switch to a lower time frame, we can observe the actual distribution pattern unfolding. These forms of manipulation might also appear as continuation patterns. For example, when the price exits a distribution pattern on a higher time frame, it often enters another consolidation phase known as redistribution. In this phase, smart money may engage in the same type of behavior but on a smaller scale. This is the perfect opportunity for traders who missed out on the first rally to join the selling campaign. That's because sometimes it's quite tricky to spot the beginning of a reversal. It can really take a seasoned eye to interpret price action near that critical area. Similarly to the previous examples, cautious traders might keep an eye out for a second chance from the market. Take, for instance, the emergence of a double top pattern below the trading range. This could serve as the final heads-up, indicating the last place of supply. Sometimes, instead of an engulfing candle, you'll see a pin bar forming to reject a resistance level. Although pin bars are reliable as reversal indicators, remember they're not quite as strong as engulfing candles. In these cases, it's wise to wait for more price action to unfold. Maybe look for secondary entries the market might offer to catch the next wave of price movement. Major market players' interventions are not limited to bull markets. For instance, following a considerable downturn in Bitcoin's value, the market entered a phase known as accumulation, where institutional whales strategically gather more assets in anticipation of a potential price reversal. In this pattern, smart money tries to convince other traders that the current trend will continue, tempting them to join in on the sell-off. But what they're really aiming to do is collect enough liquidity from these traders to pivot the market's direction to their advantage. Here, after 2 attempts to push the price down, the appearance of a bullish engulfing candle with a long lower wick suggests that the smart money may have finished their strategic positioning and could be gearing up for a substantial market turnaround. When we take a closer look at a shorter time frame, like the daily chart, we notice a string of bullish green candles. This pattern indicates that the market may have reached its lowest point, or it's very close to that level. Those last efforts by savvy investors are often referred to as springs or shakeouts. These actions form the concluding parts of a complex strategy crafted by these significant market players. If you're seeking an early entry point, consider drawing a trend line, and once it's breached on a lower time frame, you might consider going long, aligning with the smart money's move. However, if you're a more conservative trader, you might opt to wait for a pullback. When you look at shorter time frames within an accumulation pattern, you often see a link. The price movements and volume phases tend to move together, showing a neat correlation. This harmony acts as extra confirmation that the accumulation pattern could be heading in the direction you're anticipating. Also, looking out for divergences between price and RSI indicator on shorter time frames, similar to how you do with a distribution pattern, can give you some great insights. These clues can help traders predict a market reversal before the crowd catches on. Finally, we can opt for the start of the market downturn as our primary take-profit level. Here you can observe a similar pattern forming on the Euro-USD pair. However, this formation emerged after a price surge, referred to as a re-accumulation. Once again, the diminishing momentum is evident, as the market makes candles with relatively long lower shadows, explicitly rejecting lower price levels. As we narrow our focus to a lower time frame, the reaccumulation pattern becomes clearer. Once more, the repeated testing of lows is apparent, resembling an accumulation phase. Similar to the prior scenario, identifying a trend line break within the pattern can indicate potential early buying opportunities. Reaccumulation typically indicates a continuation of price upward movement. To estimate a potential price target, consider that the distance covered by the leg exiting this pattern could be similar to the initial leg that entered the pattern. To achieve this, utilize the Fibonacci expansion tool from the toolbar and set your take profit target at the 100% level. Keep in mind the Wyckoff method encompasses far more than this brief overview, covering tons of intricacies. Make sure you research the system thoroughly if you want to maximize its benefits. Best of luck, and thank you for watching.